Hello, everyone. Welcome to Money Hour Radio, a show where we try to help you grow your money, pay less taxes, and have a beautiful retirement. What could be better than that? I am one of your co-hosts, Ben Barzideh. I have my esteemed, trusted co-host here, Matt Nadeau.
Hey, everybody.
We are both founding partners and wealth managers at Barzideh and Nadeau Wealth Management, a comprehensive financial planning firm located locally in Barrington. And we are fiduciaries. And as an independent, family-owned firm, we truly have the freedom to focus solely on your interests and not some corporations or those shady private equity companies buying everything up.
Yeah, that's right. And listen, we just wanted to take a moment, say hi to all of our clients who are listening today. We definitely appreciate the trust you place in us, and we love every one of you. And of course, to all the mothers out there, hope you're having a wonderful Mother's Day weekend. Go get spoiled. If you come work with Barzideh and Nadeau Wealth Management, we spoil everybody. But,
Exactly.
Mother's Day, you got to get a little extra. Now, on to the show. I think we have a great topic or a couple topics we want to talk about. So first and foremost, we want to talk about a run hot economy. So what is it? How do you invest in it? We really want to hit on this because we believe that's what we're currently in. And then later in the show, we're going to talk about a really interesting tool that's out there for high net worth people, and it's called a credit shelter trust. And really the design is to help you reduce death taxes for your heirs and leave more of your inheritance to them. So you don't want to miss that.
And guess what? Because of state death taxes, depending on the state you live in, you may not be that high net worth to be dealing with death taxes, and you may need one of these credit shelter trusts.
Pretty soon, all the states will make it like 25 cents. They're like, all right, we need taxes.
All right. But before we start, we encourage you to subscribe to our YouTube channel on moneyhourradio.com, where you can view this week's episode along with the previous ones we have. Also, if you want, you should sign up to a weekly economic newsletter. It's called the 5-Minute Market Brief. It's informative, succinct, easy to read. We get a lot of good comments about it. You can sign up for that on bnwealth.com. And then while you're on BN Wealth, feel free to subscribe and like our social media pages on Facebook and Instagram. All right, Matt, let's talk about a run hot economy.
Yeah, and last week we actually touched a little bit on this, and we were talking about, in our opinion, we're in this environment which really seems to be what we call a run hot economy. And remember, it's one of those things that sounds great, but there's some things to watch out for. And it's something we've written a lot about in our weekly economic commentary. Definitely something that Ben, you'd mentioned, subscribe to it. It's something we send to our clients and radio show listeners. You'll really get a lot of insight. But what really prompted us to want to talk a little more about this is we actually had one of our clients a few days ago just reach out and ask for some clarification on what a run hot economy meant exactly. And of course, we found that in our almost 2 decades of being an advisor, if there's one client who has a question, it's likely a bunch of others are wondering the same thing. So we're going to explain what a run hot economy is and how it would impact your assets and what specific assets. And importantly, we'll also touch on what we feel is some of the best ways to invest in this environment.
So first, what is this run hot economy? Well, the term refers to the idea that the Fed basically allows strong economic growth and inflation to run solidly above target. And the Fed will allow that either by cutting interest rates incrementally when economic growth is solid and not weakening, and also by not raising rates when inflation is higher than they would ideally like, thereby allowing inflation to stay elevated. So economy where there's high inflation, but high growth as well. And right now, I think the economic data points to a run hot economy. So consider this. The ISM PMIs, those are gauges about economic activity. They're both solidly in expansion range. Retail sales have been strong. Durable goods, business investment, and spending, these remain just off recent highs, so very robust.
Yeah, and the other big thing you always look for in different types of economies, the labor market, and we've really seen it continue to be strong and rebound from a lull in mid 2025. And then inflation, by pretty much every measure, is solidly above the Fed's 2% target. It's higher than 3% on CPI and the core PCI price index. But, and importantly, the Fed is not voicing any intention to potentially increase rates. And of course, with Warsh becoming a Fed chair, Fed may actually want to try and cut them some more. So again, that's critical. But there's also, we want to focus on the inflation side where they may continue to be building these pressures. So the last time the prices paid index in the ISM services PMI was this high as what we're seeing right now, CPI was actually over 6%. So things have definitely heating up in the economy.
Holy cow, that's hot, over 6%.
Yep.
So, okay, let's talk about what outperforms, in our opinion, in a run hot type of economy. So, broadly speaking, hard assets and cyclical sectors should outperform in a run hot economy. Hard assets, we mean things like commodities, gold, silver, precious metals. Those areas should do well. From a sector standpoint, this means areas like real estate, areas in real estate that benefit from materials and commodities. So, home building, those type of things should do well. As far as style boxes, what type of market cap might do well? Well, guess what? Small and mid cap stocks should really outperform in this area. Falling interest rates combined with solid economic growth from various forms of stimulus should continue to benefit smaller cap companies, which have actually they've pretty much lagged pretty bad over the last few years on the slowing economy concerns and the higher interest rates. So those things are improving, and those are two good solutions to balance out potentially over allocations to large caps, which a lot of people tend to have. We also like cyclical sectors uh, over defensive sectors and super cap tech, such as the Magnificent Seven. We like cyclicals over all of those because those areas should broaden out more in a rising economic tide. And then financials. We've talked about this before. Financial and banks, and more specifically, smaller and medium sized regional banks should really do well in this environment. And then lastly, consumer discretionary. So retailers, industrials, and more specifically, infrastructure should outperform the S&P 500 and most likely the super tech areas as the rally tends to broaden to other nooks and crannies of the economy. So
Yeah,
those are the areas that we like.
and a broadening market's a good thing. Like we want to see the economy grow, and broadening out is a positive. Now, again, I want to put a caveat for all of our radio show listeners. We're saying stuff that we think should outperform. Don't go out there and throw all of your savings into one of these just because we're saying it. You want to seek professional help before you go and just start buying things. But I want to piggyback on what Ben was saying. And what about bonds? A lot of you may be in some bonds. There's going to be some areas that'll do better, like short-term and floating rate debt. Because what'll happen in a run hot economy, bonds decline as elevated inflation erodes the coupon and demands higher interest rates to offset that risk. So short-term debt and floating rate would actually outperform the typical longer dated fixed income. So those are all the areas that we really think could benefit in a run hot economy. And guess what? That's a lot of the areas that we ourselves in our advance and protect active tactical model are utilizing. Remember, we actively manage our portfolios and will shift to these areas of strength. And in fact, in some of our more growth oriented models, we actually are pedal to the metal with some of our clients' portfolios 100% in equities and enjoying the rally. We have a healthy exposure to international. We're a little overweight in small and mid caps. We do have metal sleeve consisting of gold, silver, and copper. And even though the Magnificent Seven may not be the best in this environment, they're still super strong. And we even have a sleeve for some of those.
We jokingly say that's the portfolio you can brag about with your friends at brunch, right?
Exactly.
But we strategically move our allocations towards the areas in the market that, based on our research, are rising in momentum and strength. And as the trend changes, so do our allocations. But we monitor our investments every single day. And if the market does deteriorate, we will actually get defensive by actually selling out of the stock market and going heavier into bonds or cash while we wait for things to improve. So we don't believe in riding potential market crashes all the way down in retirement. Don't settle for cookie cutter static portfolios. If our investment philosophy resonates with you and you're looking to have your money managed like that, then please reach out to us and schedule a complimentary consultation. We will go over your current financial situation and your goals. We will go over your assets. We can even do a financial checkup. If we can help you, that's great. If not, we'll still part as friends. So to explore becoming a client, reach out to us at bnwealth.com or call our office at 847-780-2980. All right, don't go anywhere, because as soon as we come back from break, we're going to talk about how a credit shelter trust can reduce death taxes and leave more inheritance to your heirs.
Welcome back. Thank you for tuning in. This is Money Hour Radio. It's a show where we try and help you grow your money, pay less taxes, and of course, have a beautiful retirement. I'm one of your hosts, Matt Nadeau. I have with me my esteemed, knowledgeable, and trusty co-host, Ben Barzideh.
Hello, everybody.
And we're both founding partners and wealth managers of Barzideh and Nadeau Wealth Management. It's a local and comprehensive financial planning firm. We're independent. We're right here in Barrington, and we're here to serve the greater Chicagoland area.
And we're not private equity either. So that's a good thing, right?
Yeah, I mean, of course.
No corporate interest to satisfy here. But before we start, as always, we encourage you to like and subscribe to our YouTube channel, moneyhourradio.com. You can see this week's episode along with our previous ones. Also, sign up for our weekly economic newsletter. It's called the 5-Minute Market Brief. It's succinct. It's amazing. Gives you a really good idea of what we're thinking, what we're seeing, what we're analyzing. You can do that at bnwealth.com. And then while you are there, please like and subscribe our social media pages. We're on Facebook and Instagram, and I think we're on LinkedIn as well, Matt, right?
Yep.
All right. So let's get into this topic today, how a credit shelter trust can reduce taxes. And listen, on our show, you know we love talking about trusts, right? On our show, talk about them all the time. And few things to us can be as romantic as a well-designed estate tax saving strategy. So it's kind of like roses are red, violets are blue. If I die first, this trust is for you. All right, okay, we kid. That sounded like one of my cheesy dad jokes, right?
Oh man, this is going downhill quick. But honestly, like, what's not romantic, Ben, is paying a bunch of extra taxes you could have avoided. That is what kills the mood fast.
Exactly. So today we want to talk about the very elegant and sexy credit shelter trust. And it's also sometimes known as a bypass trust or a family trust or an AB trust. It's got a bunch of different names, but it's really the exact same thing. And it is a common and powerful estate planning tool used by married couples to reduce potential estate and death taxes and preserve wealth for heirs. And it's especially relevant for couples with significant assets who want to maximize tax exemptions and control how their property is distributed to their heirs after death.
All right. So a credit shelter trust works by taking advantage of this federal estate tax exemption that's out there available to each spouse if you're a married couple. So under U.S. tax law, individuals can actually transfer a certain amount of their wealth tax-free at death. So right now it's about $15 million per person, but you get this ability through portability to now have $30 million per couple as of 2026. So normally when one spouse dies, their assets can pass to the surviving spouse without tax, because when you're married, there's this unlimited marital deduction. However, what happens if it passes to a surviving spouse, it can create a problem because the deceased spouse had that big tax exemption, it goes unused. And potentially, it increases taxes when the surviving spouse later dies. So in that case, the exemption is basically wasted, like one of those expired coupons you got. So what you want to do is have this credit shelter trust come into place. It's like the financial equivalent, Ben, of we're not letting that coupon go to waste.
Hey, no one likes wasting coupons, right?
That's right.
Especially not multiple $1 million ones.
You don't want
Or,
to lose this one.
or those CVS ones or Walgreens, you get those big long ones sometimes, you get like $7 off. My wife always gets mad when I lose those. So, all right. So to solve this problem, a credit shelter trust is drafted for the couple. And how it works is this. Once the separate trusts are drafted, the couple tries to, as much as possible, equally split up their assets and title them in each spouse's trust. And then upon the death of the first spouse, assets divided and titled into that spouse's trust gets moved over into an irrevocable trust rather than transferred outright to the surviving spouse. The surviving spouse can still benefit from the trust, typically receiving income and, in some cases, limited access to principal for expenses such as health or education. However, the key feature is that these assets are no longer considered part of the surviving spouse's taxable estate. And when the second spouse dies, the trust assets pass to the beneficiaries, often your children, without being taxed again.
Yeah. So this structure is designed to effectively allow couples to use both of the spouse's estate tax exemptions instead of just one. So you get to basically double the exemption. And it also ensures that the first spouse's share of the estate is actually preserved for its intended heirs rather than being fully controlled by like just the surviving spouse. So there are several advantages to using a credit shelter trust. So first, what we've talked about, the primary benefit, tax savings. That's critical. That's one of the main reasons you're going to use it. By removing the trust assets from a surviving spouse's estate, some families can significantly reduce or eliminate estate taxes, particularly when you have these really large estates. And second, this type of trust provides asset protection. And because these assets are now in a trust, they're not in your estate, they're actually oftentimes generally shielded from creditors and legal claims. And then third, you get this layer of control for your distributions. And the deceased spouse can specify how and when these different assets are passed on to the heirs or to beneficiaries. And this really becomes useful in cases where there's like a blended family or in situations where maybe remarriage is a concern. And then finally, credit shelter trusts can help avoid probate, which again, we always want to avoid probate. It's faster, it's private, it's cheaper. Just avoid probate. Number one rule.
That's a whole nother radio segment on its own.
That's
We've
right.
done that before, talking about probate and the pitfalls of it and why you want to avoid it. But despite these advantages, of course, there can be some drawbacks. There always are. Some things to take into consideration. One major disadvantage of these credit shelter trusts is the fact that they're very complex. Establishing and maintaining the trust requires careful legal planning, ongoing administrative, and sometimes separate tax filings, all of which can be a pain in the butt sometimes or increase costs. Another limitation is the lack of flexibility. Because the trust becomes irrevocable upon the spouse's death, it cannot be easily changed once created, even if family or financial circumstances shift. And then additionally, the surviving spouse does not have full control over the assets in the trust. So while they can take out income, like we said, and some limited access to principal, for the most part, they don't have full control over those assets. And so those can be something that can create financial constraints and need to be taken into consideration.
Yeah, yeah. Remember, you're basically trying to push this out of your estate, and it becomes irrevocable. And so there are constraints. You need to think these through before you pull the trigger on it. And what's happened is over time, this federal exemption has gotten to be pretty ridiculously high. So a lot of couples, it's not really as necessary to have these credit shelter trusts. Remember, on the federal level, we're talking with a married couple, it's a $30 million exemption, at least right now. Historically, it was much smaller. However, what we're seeing, though, is even with this high federal level, is that it can be useful for some people living in states that have separate estate taxes. And guess what? My good friends of Illinois, we're one of them that have one of these death taxes. And the threshold is unfortunately not 15 or 30 million, it's 4 million. And spouses do not get to automatically double that exemption to 8 million with portability like they can on the federal level.
And it gets even kookier on Illinois death taxes. We've talked about this on the show as well, where if you go $1 over that 4 million, the whole thing gets taxed, not just that dollar that goes over it.
Spend that dollar, people.
Oh, and it's a progressive tax. So at first, I think the lowest threshold starts at 4%, and very quickly it can go up to a 16% death tax. So very necessary in certain states. So depending on the state you live in, you may need one of these. So in conclusion, the Credit Shelter Trust is a very powerful but complex estate planning tool, and it's designed to minimize taxes, protect your assets for future generations, but whether it's appropriate or not really largely depends on the size of your estate, your family circumstance, and current tax laws. And speaking of that, current tax laws, Matt, I know with the One Big Beautiful Bill Act that went into effect last year, a lot of these tax provisions were made permanent. But permanent in Washington doesn't mean the same thing as permanent does in other areas. Permanent means for about 4 to 8 years, basically, until there's a
Maybe,
change.
if you're lucky.
So those big numbers we talked about, the 15 and 30 million, gosh, those could change and go right back down. And then, to just a few million, the country does need extra tax revenue, 40
Yeah.
trillion of debt. So those can be subject to change. But for now, that's how it works. So as with any financial planning, investing, tax, or estate planning strategy, it's essential to work with qualified professionals who understand the concepts, can tailor them to your unique situation. And usually a good financial planner like us, we're like the quarterback of your plan, and we help coordinate it with your other professionals like your CPA, your attorney. And if you are in need of a good financial planner, someone who puts your interests first, we would be honored if you gave us an opportunity to speak with you. And if our investment and financial philosophy resonates with you, please reach out to us and schedule a complimentary consultation. You can do that online at bnwealth.com or call our office at 847-780-2980. And lastly, please like and subscribe to moneyhourradio.com. All right, we're out of time. God bless you. We will see you next week.
All right, take care, everyone.